All right, let's dive right in. Today, we're getting into the weeds on one of the trickiest and frankly highest stakes parts of payroll, mistakes in state tax withholding on the W-2. With so many people working remotely now, getting this wrong creates a massive headache for both companies and employees. So let's deconstruct it.
So, here's our game plan. We'll start with the legal bedrock, why the W-2 is so important in the first place. Then, we'll dissect the key state tax boxes, 15 through 17. After that, we'll look at the huge difference between fixing a federal versus a state error, talk about the penalties and a really dangerous trap to avoid, and finally, tackle the worst-case scenario, the wrong state dilemma. All right, first things first, before we get into fixing errors, we have to understand that the Form W-2 isn't just some administrative task. It's a legally mandated document with its roots deep in federal law. This quote just hits the nail on the head, doesn't it? With employees scattered all over the country, employers are trying to navigate this labyrinth of state tax rules. And it's this exact complexity that's causing a huge spike in withholding mistakes. And the legal muscle behind all this? It's Internal Revenue Code Section 6051. This is the federal law that says employers must provide a W-2. It's not a suggestion. It's a rigid statutory command. This is the cornerstone of the whole wage reporting system. Okay, now let's zoom in and get granular. We're going to focus on that little block of boxes at the bottom of the W-2. This is the epicenter of state reporting, and it's where most of these really complex errors happen. Think of Box 15 as the jurisdictional anchor. It's not just the state's two-letter code that matters. It's that employer's state ID number. That specific number is the key. It's what state revenue departments use to match the W-2 to the employer's quarterly wage filings. If that number is wrong, the whole electronic matching system just grinds to a halt. Now, here's a classic trap. A lot of people assume that state wages in Box 16 should just match federal wages up in Box 1. But they often don't. Why? Because every single state has the right to decide for itself what counts as taxable wages. They can, and often do, have different rules than the feds for things like 401k plans or fringe benefits. And finally, Box 17. This number isn't an estimate, it's cold, hard cash. It is the exact amount, down to the penny, that the company withheld and sent to the state treasury named in Box 15. And you better believe it has to match the employer's deposits perfectly. Even a tiny mismatch is going to get flagged by the state's computers and trigger a notice. So what happens when you find a mistake? And trust me, you will. Well, this is where things get really complicated because you're not playing by one set of rules. You're trying to navigate two completely separate and often conflicting frameworks for federal and state corrections. Look at the difference here. On the federal side, for income tax in Box 2, the IRS is incredibly strict. You can't just go back and change a prior year unless it was a simple administrative error, like a typo. But for the state boxes, those federal rules go right out the window. State law takes over, and if the wrong state is listed, you absolutely must issue a corrected Form W-2C. No exceptions. So how do you actually fix it on the form? You have to use this special two-line method on the W-2C. It's like a journal entry. First line, you put in the incorrect state information. You enter the bad numbers in the previously reported column, and then you put zeros in the correct information column. You're zeroing it out. Then on a second line, you enter the correct state, put zeros in the previously reported column, and enter all the right numbers in the correct column. It seems weird, but it's the only way to get the state computer systems to understand what you're doing. Okay, fixing the paperwork is one thing, but these errors come with real financial teeth. We're not just talking about administrative hassle. We're talking about serious federal penalties and a compliance trap that catches so many employers off guard. You see, one wrong W-2 is actually a double violation. Under the Internal Revenue Code, you get hit with a penalty under Section 6721 for filing an incorrect return with the government, and you get hit with another penalty under Section 6722 for giving an incorrect statement to your employee. It's a double whammy, and those penalties can add up fast. Now, you might be thinking, okay, but what about small, honest mistakes? And you're right, the federal government does give you a little bit of a break. It's called a de minimis safe harbor. If the mistake in the amount of federal tax withheld is $25 or less, you're generally safe from those penalties we just talked about. Okay, listen up, because this is probably the single most important point of this whole breakdown. That federal safe harbor, it means nothing to the states. Absolutely nothing. It has no legal standing, it doesn't apply, it's irrelevant, it is a trap. Let me be crystal clear. A tiny $10 error in California withholding, a $5 error on a New York W-2, that is a full-blown, strict liability violation of their state laws. The federal safe harbor gives you zero cover. A correction must be filed, period. And that brings us to the messiest, most difficult scenario of all. What happens when the money has already been sent to the wrong state, and the employer just digs in their heels and refuses to fix the W-2? This is the ultimate gridlock. The employer has already sent thousands of dollars in withholding to California's Treasury. The employee comes along and says, "But I live and work in Texas. You sent it to the wrong place." The employer then refuses to issue a corrected W-2C, arguing, "Look, my W-2 is accurate. It shows what I withheld and where I sent it, even if where they sent it was totally wrong." So what now? What can the employee actually do when they're stuck holding a legally incorrect W-2 that their own company won't fix? How do they ever get this sorted out? Well, the entire burden, and it's a huge one, shifts to the employee. They basically have to fight a two-front war. First, they have to claw their money back from the wrong state. To do this, they have to file a non-resident tax return there. And here's the crazy part. They have to report $0 in income from that state, even though their W-2 says otherwise. But they claim the full amount of withholding as a payment. This creates a giant overpayment and forces the state to send them a refund. But it gets worse. At the very same time they're doing that, they also have to file a return in their actual home state. And on that return, since their W-2 shows no tax was paid there, they're now staring down a massive tax bill. They have to pay that entire amount out of their own pocket by April 15th, all while just hoping that the refund check from the other state eventually shows up. It's a brutal cash flow nightmare for the employee. So let's boil this all down. What are the big takeaways? First, state withholding lives and dies by state law, not federal rules. Second, that federal $25 safe harbor is a dangerous trap. Ignore it for state purposes. Third, when a wrong state fight happens, the employee gets stuck with almost all the work and all the financial pain. And finally, all of this proves that if you're a business with employees in multiple states, you absolutely must be doing rigorous payroll audits during the year to catch these things early.
And this really leaves us with the big forward-looking question. Remote work isn't going away. It's the new reality. So, are the states going to get together and create some kind of standardized, sensible system for fixing these errors? Or is this compliance labyrinth just going to get bigger and more complicated, trapping even more employers and employees in the middle? That's what we'll be watching.